Stay like Bloomberg.
Live from New York City this morning. Good morning. About 22 seconds away from the opening bell. Equity futures up 0.6% on the S&P. On the Nasdaq up 0.8%. The small caps, the Russell, up by around about 0.8% as well. The opening bell in New York City rings. There we go. Switch at the board and get to the bond market. Yields look like this on a 10-year. Your 10-year lower by 6 basis points. The yield 367.90 last year. This time last year 164.73. That's the move over the last 12 months. A monster move. In the FX market, euro dollar 106.13, positive 0.6%. One to watch here. German inflation yesterday softer than expected. Disinflation in France this morning. Is that going to be the trend? Can the ECB back away? Perhaps not yet. In the commodity market, crude 74.63. We're negative there by about 3%. The oil majors, some of the energy companies had a tough ride of it just yesterday, so we'll look at that around the opening bell as well. Into the open we go. About 30 seconds into the session, we're positive by 0.5% on the S&P. On the Nasdaq up by 0.75%. The stock to watch at the open, Tesla, coming off its biggest day of declines in more than 2 years. Abby has the story. Hey, Abby.
Hey, John. Well, this one is really pretty incredible because, of course, yesterday down more than 12%, the worst day since September 2020, after falling 65%, the worst year ever since going public last year. So the wild ride continues. That's true, too, in the pre-market at one point up more than 2%, then down right now up about 0.5%. And it has everything to do, of course, with that pre-announcement, that typical pre-announcement that they do relative to deliveries. While it was a record, it was not quite what the street was looking for. So relative to the S&P's performance yesterday, Tesla was the biggest, second biggest point drag right after Apple. Now, relative to the deliveries, it's really interesting because, of course, there were record deliveries right about 400,000, but shy of that 420 estimate, and also missing the estimate for a third quarter. The bigger story could be growth stalling, but you still have analysts very positive. We have 56% of the analysts on the street having a buy recommendation, 11% a sell. That could have something to do with valuation. Now, I know everybody says that the stock is overvalued, but when you look at revenues for this current year at 34% growth expected, profit around 30%, the PE, the forward PE, is 21 times. So you could make the case that it is a GARP story. They still own 85% of the luxury car market, 60%, 65% of the overall EV market. Here is the growth, though. Here's the story. And here's the big question, John, because the first quarter of this year, you can see, or last year, I should say, growth was close to 70%, and that's where it had been. And then in the second quarter, slowing to about 30%, 42%, 31%. Now, of course, that slowdown does seem to coincide with Elon Musk moving toward Twitter. The question is this big slowdown, is it macro or is it some loss of focus on the part of Elon Musk? I would argue it's too early to know, but it is a question to ask, and perhaps CEO Elon Musk is going to be putting more focus on Tesla. Of course, he is telling the employees of the company that these market gyrations don't pay attention to them. Long term, the fundamentals are strong.
Abby, thank you. That stock right now 108.50, trying to bounce by 1/3%. Another stock to watch is Salesforce, announcing plans to cut 10% of its staff. That's almost 8,000 jobs. How many times are you going to see a quote like this from a CEO of a tech firm this year? As our revenue accelerated through the pandemic, we hired too many people leading into this economic downturn we're now facing, and I take responsibility for that. Kelly Lyons has more. Hey, Kaylee.
Hey, John. What does Tom always say? Companies adjust, and that seems to be what Salesforce is doing here. Investors seem to like the move this morning. The stock is up more than 3% in the first few minutes of trading. As you said, 10% of the workforce, those laid off employees will be provided with a minimum salary of at least 5 months worth of pay and severance, health insurance, and other resources. So that altogether is going to result in charges of up to $1.4 billion. Plus, in addition, Salesforce is going to make select real estate exits and office space reductions in certain markets, which could add another $650 million in exit charges. So all said here, we're talking charges of up to $2.1 billion for this restructuring in the next couple of years. Now, why is Salesforce doing this? You heard it from Benioff himself. They just overhired. It has almost tripled its workforce in the past 5 years. In large part, that was through a number of acquisitions, but it also picked up the pace of hiring during the pandemic boom, and now he realizes that was too much. He's noting that customers are taking a more measured approach to purchasing decisions. In other words, demand is slowing down, hence why the company is projecting the slowest revenue growth for the current quarter since going public back in 2004. And at the same time they're facing that pressure on the top line, They're also facing pressure from investors, including activist Starboard Value, to improve their margins and focus more on profit. Basically, in a world of higher rates, it is no longer enough to talk about profit way out in the future. They want to see it now. And to Salesforce's credit, we're looking here at revenue and net income, revenue in blue, net income in orange. They are estimated to add over $1 billion in net income on just about a $160 million sales increase. So trimming more fat, trying to take more home, and job cuts are part of that, John.
Hey, Kayleigh, how much more of that are we going to see in the year ahead? We've seen a lot of it already to close out 22, to start 23. Starting to see more of the same. Kelly Nice, thank you. We are about 5 minutes into the session, up 0.4% on the S&P, on the Nasdaq, up 1/3%. We caught up with Mike Wilson of Morgan Stanley earlier this morning, still looking for a potential 20% downside on the S&P 500.
We think 3,000 is a very achievable number. Given our confidence on our earnings forecast. Our bear case is actually we avoid a recession but not the slowdown. That would be the 3,000 scenario and $180 in earnings. Bank of America's Savita Subramaniam seeing reasons to be optimistic, writing the following. One reason we are more constructive on equities in 23 is the big drop in sentiment during 22. It has been a bullish signal when Wall Street strategists were extremely bearish and vice versa. Savita, I'm pleased to say, joins us right now. Savita, wonderful to catch up with you and a happy new year to you and the whole of the team over at BofA. Let's start there. Are things that bearish it's bullish in January?
Happy New Year. Yes, I think, what's nice to see is that there's a lot of bad news out there, but everybody is talking about it now. And what we found is we have an indicator called the sell-side indicator, and it's been one of the most reliable market timing barometers in terms of forecasting returns over a 12-month period. All we do for this indicator is we take the average recommended allocation of sell-side strategists, so myself, Mike Wilson, my counterparts, and we calculate that number over time. And what we found is that when strategists are recommending a big overweight in equities, that's precisely the time you want to sell. And when they're starting to drop that allocation and up allocations towards cash and bonds, that's precisely when you want to buy. Where are we today? We're at a 53% average recommended allocation to stocks. This is the lowest we've seen in almost a decade, and it's close to where we were in 2013, which was, again, another very prescient moment in time where this indicator told us, okay, everybody in the world hates equities. Strategists have thrown in the towel on stocks. We're in a recession. Europe's in a recession. We ran out of money in QE. That was back in 2013, and lo and behold, it was one of the best times to enter the equity market over the last 10 years. So I think, our view is, okay, it's going to be difficult. It's not going to be as easy as just buying the index and clocking in fantastic returns every year. But we do think that the good news is that folks are talking about all of the bad news. So in a nutshell, sentiment is increasingly negative. It's dropped significantly from where we were at the beginning of 2022. Interestingly, at the beginning of 2022, strategists had upped their allocations to a 60% weight in equities and a pretty low weight in cash and bonds. And, we all know what happened to equities versus cash over the next 12 months. So I think that this is a moment where we've seen a lot of that bullishness wash out of the market. Now, I'll give you one statistic. So if you look at where the indicator is today, at how bearish Wall Street strategists are today, historically, when we've been at these levels of bearishness or lower, the market has been up 95% of the time over the next 12 months. That's a pretty good hit rate. So, I think that there might be a little bit more upside risk over the next 12 months than downside risk at this point.
Just to build on something, Savita, just quickly, I've had this question already this morning. So the rhetoric is bearish. Does the positioning line up with that?
So it's interesting because positioning in stocks has dropped a bit this year from last year, but a lot of that was just driven by performance. So if you look at allocations at the beginning of 2022 and at the end, most of that drop in allocations was just the fact that equities underperformed cash. I think that where we are today is an environment where what's risky is that investors are still hugging a lot of those secular growth long duration areas of the market. They haven't really shaken this love affair with technology and TMT, and I see that as the risk within the equity market. That area of the market is still relatively crowded. Surprisingly, energy, even though it's had, a stellar couple of years of performance, is still a pretty significant underweight in the average mutual fund. So I still think there's a lot of alpha to be made in sectors, but we have seen allocations in overall equities come down. The problem for me, though, is that everybody's talking about this recession. We've got the most telegraphed recession in the history of mankind coming up, and the problem is everybody is kind of using muscle memory to go back into what they think of as the safest equity market, which is the S&P 500. Trouble is, if everybody is in the S&P 500 and they're all selling at the same time, the S&P isn't really that safe. So our view is that within the equity portfolio, the S&P 500 is actually the most crowded ticker in the world, and it's time to go into other benchmarks like small caps. And we've talked on your show quite a bit about small caps, my colleague Joe Hall and I. And I think that's really an area where you can get exposure to equities without the risk of everybody being crowded into the same index fund.
So Savita, that's the index story. Let's work through that a little bit further. Clearly you think there's an opportunity here. It's not at the index level for the S&P 500. It might be in the Russell. Can you just go through sectors for me with a little bit more detail, Savita? How would you express this through sectors right now, this month?
Absolutely. So I think, we're still underweight tech. We're still underweight communication services. I think those are still areas of the market that look crowded, relatively expensive. I know on some metrics, communication services looks cheap. TMT looks cheap. But the problem is TMT is a big value trap. The reason it looks cheap is that prices have fallen faster than analysts have cut earnings expectations. When we look at tech and TMT, we think earnings are likely to come down another 15% from where consensus is right now. So those are not sectors that I would be jumping into. I think where the action is going to be is the inflation plays. I still think we're in an environment where inflation might be stickier and higher than folks are expecting. Sure, it's coming down a bit, but 7% is still a lot higher than 3%. So we like energy, we like financials. I think another area that might be interesting over the next couple of years is select industrials that benefit from traditional kind of picks and shovels types of CapEx, because what we're also seeing is this massive reshoring boom where companies, mostly tech companies and multinationals, are bringing plant, property, and people back to the U.S. And that is good for automation plays, it's good for industrials, and it's also good for U.S. domestic focused companies. So I think, even there, the small cap benchmark looks a lot more domestic and safe rather than other areas of the spectrum.
Savita, I just want to squeeze this in if I can and just build on that. There's something you said in your research recently, and it was a risk factor. It was the less smooth earnings streams that you can expect from diversified multinationals. Is that part of that theme?
Absolutely. Thank you for bringing that up. I think that's a really important point. So multinationals look great because they've got this global diversification. Their earnings are super smooth. They've had the benefits of globalization, this secular theme for the last 20 years. Now, all of a sudden, wham, they're hit by, supply chain issues. They're hit by, moving to net zero and moving stuff closer to their end user. These are companies that are in the process of rejiggering their entire structure, and I think their earnings are going to be much more volatile than some of the more domestic plays.
Savita, wonderful as always. Great to catch up. Really nuanced stuff, I have to say, from the team at Bank of America. Savita Subramaniam there on a more constructive view beneath the index, away from the S&P 500. Coming up on this program, challenges mounting for big tech.
We forget how cyclical some of these tech stocks are, and I think that's what you're seeing with Apple and sort of Tesla right now as these sort of recession concerns mount.
Once Tesla's biggest bull, cutting his price target just moments ago. That conversation up next with Pierre Ferragu of New Street Research.
global equities can't do well this year unless tech does less badly. Earnings will be under pressure. We forget how cyclical some of these tech stocks are, and I think that's what you're seeing with Apple and sort of Tesla right now as these sort of recession concerns mount. But also, remember, valuations have been absolutely crushed. And if bond yields stay well controlled here and with valuations having turned around, I think that's where you're going to get some tech relief this year.
The tech sector already running into trouble this year with two giants warning of slowing demand. Tesla dropping the most since 2020 after its latest deliveries miss, and Apple's market value falling below $2 trillion after telling its suppliers reportedly to make fewer components. With us, Kevin Tynan and Kelly Lyons for more. Kevin, can you tell me what is the big move, the big driver behind this move lower in Tesla?
Well, I think, look, this is the first time that as an automaker, this is a company facing macroeconomic pressure, which they've never done before, right? When you look at legacy automakers and the cyclicality of the industry have been through these good times, bad times, dozens of times over. When you look at the auto tech companies, the Teslas, Rivians, Lucids, even Tesla going back to 2010, 2013, when they started mass producing Model S, have never seen this kind of demand environment. It's always been easy money, stock going up, able to raise capital, sell all you build, and this is the first time that they're in this kind of economic challenge.
Kaylee, is that catching up with Apple as well?
Yeah, on both the supply and demand side is really the problem for Apple here, John. A year ago yesterday, this was briefly a $3 trillion company. Now it's less than a $2 trillion company, even if it's rebounding by about 1% today. And of course, this was a stock that had been more insulated from the pain that hit big tech this year. It was only down 30% in the last 12 months relative to steeper declines for the broader NASDAQ 100. But now, on top of the existing supply concerns around the COVID-0 policy in China, which has led a number of analysts to take down their estimates of how many iPhones the company ultimately is going to sell in the holiday period that just ended, those expected to be down about 3%. Now it is also about demand concerns, with the reports this week that they're asking suppliers to reduce making some of those components for devices because of weakening demand. And of course, John, as you mentioned earlier, that's why Dan Ives over at Wedbush cut his target on the stock today.
Difficult end of 22 for these names, difficult start to 23 as well. Kevin, Kaylee, thank you. New Street Research calling Tesla one of its top picks for the year, despite cutting its price target of $320 from $450. Pierre Ferragu writing, a recession could slow Tesla in 23, but the company is by far the best positioned to fly through tough times, growing profitably. Recent concerns are overblown. Pierre, I'm pleased to say, joins us right now. Pierre, thanks for your patience, sir. Let's get straight to it. Easy to trash a stock that's down more than 60% since the start of Q4. You tell me why the bears are wrong.
Yes, absolutely. Let me tell you what the bears are looking at. They're looking at what's happening at Twitter, what's happening with Elon Musk. It's a source of concern. It's very legitimate. Now, what they're overlooking is that the Twitter thing is a very small moving part financially. And then Elon Musk has already been in the past very hands-off with Tesla. Tesla is now a very, very well-oiled machine. Tesla still needs him as a CEO to make the calls, to make the decision, to arbitrate. But his direct daily involvement in the company is not necessary. We've seen that already in the past. And the second thing the bears are looking at, I think, with the wrong angle, is like the very steep demand slowdown we've seen in the last few weeks. So let me be clear. This demand slowdown is happening. Tesla has lower prices in China. Tesla has massively discounted cars in December in the US market. And Tesla came out with like a doubling of cars in transit at the end of the quarter. So very clearly, demand has gone through like a steep deceleration in recent weeks. Now, what the bears are missing is that we are talking about growing volume 30% or 35% instead of 45%. We are still talking about a company that has a run rate delivery on an annualized basis of 1.6 million cars today. A year, 400,000 a quarter, whereas the company delivered in 2021 less than 1 million units. So we still have a very strong growth trajectory for Tesla. And that's this like delicate angle the bears are missing. What's going to happen next year, John? We're going to see Tesla going through a recession. That's very clear. Now, let's see at what next, this year, of course. What is this year going to look like? What would this year be looking like if we had no recession? Tesla would lower their average selling price by about 10% and increase their addressable market by 50%. The car industry is extremely elastic, and so Tesla would be growing volumes by 50%, filling in 2 new fabs in Austin and in Berlin, generating significant margin expansion. Okay, in a recession, what's happening? Let's say auto demand is down 15%. That's a fairly bearish view, especially for higher-end autos. Then instead of doing that, Tesla would still take their prices down by about 10% and will grow volumes 35% instead of 50%, because 15% of the demand is going to go away in a recessionary environment. So we think Tesla still grows very well through the recession, number one. And number two, taking ASPs down from here for Tesla, we think happen without a significant impact, negative impact on gross margins, because Tesla is ramping 2 new fabs. As the fabs ramp, the fixed costs are being absorbed. It's a tailwind to margins. Tesla benefits from massive subsidies in the US. And last but not least, something that most people looking at it overlook, as Tesla is ramping Berlin, Tesla stops shipping cars from Shanghai to Europe. And that's a very significant cost saving. And then last but not least, of course, Tesla is ramping the most efficient car manufacturing facilities in the world, and is still lowering its overall cost base. So what the street is missing is this idea that through a recession, Tesla is going to grow slower, and it's still going to be able to do that at the premium margins they're experiencing today.
So Pierre, this is pretty constructive stuff, including the maintenance of margins, even with price cuts. But let's go with that. Pierre, can you tell me what kind of margin, what kind of multiple rather, that story deserves? Because I think that's what people are struggling with at the same time. With the Federal Reserve speaking just 50 minutes ago, talking about one official talking about taking rates to 5% plus and keeping them there. What's the appropriate multiple you put on that story?
Yeah, it's a very good question, and it's actually the reason why we adjusted our price target today. So when you look at Tesla, you need to think about long duration high growth. So when the stock is fully valued, the multiple recognizes that Tesla is going to grow at a very high pace for multiple years. That kind of stocks, let's talk like the one that comes to mind, of course, is Amazon, have derated very significantly in the last 15 months. And that's like the result of interest rates going up. When interest rates going up, of course, the value of time is changing, and valuations that depend a lot on long-term growth are getting cheaper. So I think stocks like that today could trade, in the 40 to 60 times earnings range when fully valued, whereas they were trading a year ago in the 50 to 100 range. So you've had a significant derating, but we're still talking 40 to 60 times earnings, because these are still businesses that can grow, volumes 40 to 50% a year, revenues 30 to 40% a year, and earnings very close to revenues, because they have defensible margins. So the price target we set today is basically like 40 times the earnings we expect for 2024. Yeah. And that gets us above $300. So that means we see the stock almost tripling as you get back to a 40 times earning multiple. That sounds, for a very high growth stock, like very reasonable compared to what we've experienced in recent years, of course. But we think that's the right way to think about it, because we are in a high interest rate.
I'm up against the clock, but I appreciate the constructive view. But there's a ton of bearishness out there. That right there is one of the buys from Pierre Ferragu of New Street. Pierre, we'll catch up soon. 25 buys on that stock. That was one of them. Holds 14, sells 5. A very contentious story over at Tesla. The more constructive view from Pierre Ferragu. From New York City this morning, good morning to you all. About 26 minutes into the session. Equities are up by about 0.5%. This was the countdown to the open. This is Bloomberg TV.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day. Here are the top market stories that we're following for you at this hour. New year, same layoffs. Salesforce joins the growing list of tech companies firing workers, warning of an economic downturn. That stock is up almost 4%. Back Kevin McCarthy. Donald Trump tries to turn the tide for McCarthy as he fights for the gavel after 3 failed votes for Speaker of the House. 5.4%, then a pause. Minneapolis Fed President Neel Kashkari has penciled in a pause for the Fed, signaling more hikes to come before we get there so far this year. We're going to get the latest read on the economy with JOLTS and ISM, which is breaking right now. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, we got the data. What we got?
Okay, I think the JOLTS number looks a little frightening from a market perspective. It's a little stronger than anticipated, quite a lot stronger than anticipated. The ISM manufacturing number comes in broadly in line with expectations. Those are the headlines. Let's get the details. Mike McKee, over to you.
Guy, you're right. We have a very strong JOLTS number, and it's important to the markets because it's important to the Fed. Their argument is that unemployment doesn't have to come up too much because there's still a lot of job openings for people to absorb people who lose their jobs, and that is certainly the case. 10,458,000 is the number, and that is up from 10,333,000. So a significant increase in the number of open jobs. If indeed that is correct. We were talking earlier about the fact that some of these may be duplicates, but it's still a lot of job openings. And according to the BLS, 6.1 million people were hired during the month, so that still leaves vacancies of about 4 million. So the labor market, as far as the Fed is concerned, will remain extremely tight, and that pushes you into that higher wages category. However, the good news on the other side, if you could call it that, is that ISM manufacturing falls to 48.4 from 49. It does show the Fed's medicine is working to slow the economy on the factory floor. New orders fall to 45.2, but here's the number that's going to get Wall Street excited. Prices paid fall to 39.4. That's the lowest since April of 2020 when, of course, the pandemic was just hitting. But basically, it shows that on the factory side, goods prices coming in, the raw materials prices are falling significantly. Backlog of orders rises a little bit, and new export orders falls. So overall, it is a reasonably good report for manufacturing PMI. Let me just mention in employment at 51.4. That goes up from 48.4. So people still have jobs, and there are still job openings. That's the conclusion. The labor market, at least according to these 2 data points, remains strong.
Hey, Mike, great breakdown for us. Thanks so much. Bloomberg's Michael McKee. So for more on the ISM data, we're joined now by Tim Fiore, the Institute for Supply Management's Manufacturing Business Survey Committee Chair. Hey, Tim, good to see you. Happy New Year. So Mike broke down those numbers for us. What led the decline in manufacturing?
Okay, so let's talk about the employment side. We're still running for every 3 panelists that are reporting. 2 of them are still hiring. And I was a bit surprised our employment number went up, but it didn't go up a lot. I mean, less than 52, it's kind of marginal. From a prices paid standpoint, we're sitting at 87% of our respondents saying that they're paying the same prices or lower in the month of November, which is very similar to November, which is up from a 67% back in October. So there's definitely an impact going on here. The big story, I think, with ISM manufacturing is the lack of demand. We mentioned it last month. It's still continuing this month. You can see that the new order number probably had the biggest influence on the PMI easing off a bit again. And you know, my whole demand measurement is the new export orders, obviously, customer inventory, which is still about right, not too high, not too low, and the backlog's still very weak. So we're waiting for buyers to re-enter the market here and re-up on their order book so we can get material flowing properly at the proper lead times.
Okay, so to that point, Tim, good morning, Happy New Year, it's Guy. How close are we to the bottom when it comes to this data?
Well, it's a good question. We just finished our forecast, and the survey panelists believe that the first half of the year is going to be a little bit more difficult than the second half for sure, but they don't see it as being a lot different from the second half of last year. So that's very positive. But if you look at what's happening here, we've got We have 80% of manufacturing industries in contraction now, 80%.
Wow.
But that doesn't mean that could be a 49, could be 49.5. So I've been starting to track the percent that are under 45. And we had 31% in the month of December being at 45 or less. And some pretty significant industries in there too. And that's up from a 13% back in November. So we still seem to be on a decline here. But we're staying in that 48 to 52 range. I'd like to see us get back to 51. You know, hopefully January will do that. December is a weird month. I mean, and this year, 2022, it was a weirder month because people kind of just took a deep breath.
Yeah.
A lot of people took vacations to get ready for 2023.
So, Tim, in theory, they're going to need to re-up their order books, like you said. When does that happen, ... What kind of recession are the companies going to be prepping for when they do that?
Well, we're thinking that we're not going to see a manufacturing recession. We're contracting, but for the whole 12-month period for next year, our outlook is pretty stable compared to 2022. So, you know, where are the buyers re-entering? I mean, the lead times are still stubbornly high. We didn't have much of a movement in lead times on raw material in the month of December. Disappointing. Last month, I believe I reported that we were still 30% above the trough lead times. So we still have a ways to go. Prices are coming down. Suppliers are delivering better. The lead time, reorder lead times are still stubbornly high, and I think that's what we're waiting for to budge. Like I said, December was an odd month. January is kind of a reload month. February, we should get stronger. December was actually our biggest impact by seasonal factors all year. So the numbers would have been weaker without the seasonal adjustment factors, and that starts to shift in the February timeframe.
Okay, that's interesting. Tim, go industry by industry, top to bottom. What are you seeing?
Well, still concerned about chemicals. We've had 5 to 6 straight months now of contraction, and they're now down in the low 40s. Computer and electronics are number 1, and chemicals is number 2, is in the mid 40s. So we only have one of the big 6, which is 70% of manufacturing expanding, and it's not expanding very strongly. So transportation equipment was probably a bit of a surprise. We came in at 49. Again, not contracting heavily, but contracting nonetheless. So that kind of goes back to why I'm splitting the contraction and the contraction under 45 as a key measurement. I think I was surprised at 31% of manufacturing that's below 45.
Yeah.
I'm hoping that it doesn't go much more than that.
Hey, Tim, based on that, with the employment picture still holding up at 51.4, if more companies industries keep slipping into the contraction territory, can that employment number hold up?
Well, so, you know, I've been tracking the hire to fire ratio. We've been running 2 to 1. I mentioned at the beginning of the show. We still closed the month of December at 2 to 1. We had fewer layoffs in December than we did in November, but I think that's a seasonal anomaly. And I think that rate is going to probably pick up in January, maybe in February. So, you know, like I said, for every 3 companies that are reporting, 2 are still hiring. And their ability to hire has gotten better, no doubt about it. But, you know, from an employment standpoint, manufacturing is predicting that we'll expand our employment in 2023 at a fairly significant rate, but it's probably not going to happen until the second half, which means that there'll be a lot more juice there in that 6 months than there would be over the 12-month period.
Fascinating to hear you say that. Fascinating to hear you say that you don't expect a recession this year either. Tim, great to get the data. Great to get it broken down in such detail. Thank you very much indeed. Happy New Year. Tim Fiore, Chair of the ISM Manufacturing Business Survey Committee. The JOLTS data kind of feeds into that narrative as well. Let's talk about what we're going to talk about next. What outperforms cash this year? It's a big question. It's a serious question. When you're getting what you're getting in money market funds, what risk assets are going to do better? Alexandra Wilson, Elizondo, Goldman Sachs Asset Management, Head of Multi-Asset Retail Investing, coming up next. This is Bloomberg.
It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence. This could go a lot of different ways.
The December Jobs Report, Friday on Bloomberg Television and Radio.
Going into 2023 is probably going to be a little bit more bottoms up, a little bit more dispersion amongst stocks, even perhaps within sectors. I think being a bond investor is harder than being a stock investor right now, because being a bond investor, you don't know if you're going to get a labor cycle. Okay, but in the equity market, we don't really care, because if you don't get a labor cycle, then the margin's going to be even worse. So I think either way, we're going to get a nasty earnings recession. And so the companies that can deliver on the cost efficiency are the ones that are going to continue to perform until you fully price, whatever this downturn on earnings are going to be.
That was Mike Wilson, Morgan Stanley, with the outlook for stocks and bonds in 2023. And I got to say, market's not liking the data at the top of the hour. You got the Nasdaq 100 up by 0.6, S&P erasing any earlier gains. Our question of the day: what outperforms cash in 2023? We have a lot of money on the sidelines. What's going to draw it back in? How do you put that to work? Joining us now, Alexander Wilson Elizondo, Goldman Sachs Asset Management Head of Multi-Asset Retail Investing. What outperforms cash? Can anything?
Good morning.
Good morning.
It's a great question. Right now, you're being paid to be patient with money market yields close to 5%, especially when you're facing what could potentially be a meaningful recession coming our way. So from our perspective, we're looking at areas where there are real material new pieces of information, such as the information coming out of China with the zero COVID policy. But there's a little bit of a give and take. So, as the zero COVID policy comes out, you're going to see mortality rates increase. You're going to see mobility decline. So there's a more safe way to play that narrative from our perspective. And we're really looking to do that in emerging market debt, where you're getting exposure to the growth in China through being very large trade partners. You're facing what is going to be a change in their hiking cycle, so hopefully that's going to be pausing and moving in the other direction. And then ultimately, you're going to be a beneficiary of a lot of the onshoring or some of the, deglobalization that's happening. So we think that there's some great options in the market available to us right now, but to your point, we're being paid to be patient. And we really want to see what's going to happen with the fundamental picture. And, when we look at credit spreads or equity valuations, we just think that you're not really being paid for a lot of those risks.
Good morning. What data are you watching to tell you when you to make a pivot on that as well, particularly when it comes to kind of developed market equity markets? We're looking at data. We've just seen the JOLTS data. We've just seen the ISM data. The JOLTS data is strong. So what numbers are you watching most carefully?
So right now, actually for today, later on today, one of the things we're really paying a lot of attention to in the minutes is the Fed's reaction function and how it may be changing, the variables that they're paying a lot of attention to, and then the weights on those variables. So from our perspective, there was a meaningful change from what was the November rhetoric to December rhetoric in terms of hawkishness. And so the dove voices, they kind of went into the background. So what is driving that change? From our perspective, it's very much so a focus on the labor markets and core service inflation and the tightness of those labor markets. And so we're going to be paying attention to not just JOLTS this morning, which effectively is going to show you that this ratio of openings to seekers still remains very well above pre-COVID levels, which was around 1.2, and even if we're at 1.7 or 1.8 now, it's still very high. But average hourly earnings is going to be really important on Friday, because it's going to show that tension in the labor market between supply and demand, how strong that tension is. And ultimately, we think it's going to be a very large driver of how the Fed responds.
And you can also just see that, like in the ISM, for example, that employment's still holding up, and that sort of feeds that tight job market narrative. What's interesting to me is Neel Kashkari wrote on an essay posted on Medium.com today, and he said, look, we're going to keep raising rates to at least in the next few meetings, want to see inflation peaking, pause at 5.4%, and then we're just going to hang out there. Like, we don't know where the peak is going to be. Markets did not do anything on that. Like, they're moving on the data a little bit, but like, are we ignoring the Fed now at this point?
Yeah, one of the key risks we actually see for the first quarter is that the markets are mispricing this risk. In fact,
risk of like keep hiking and then holding.
Keep hiking and holding, and the resolve of the Fed. So the market's basically kind of saying, okay, we don't really think that there's going to be this resolve, and ultimately that will turn. But we're seeing actual productivity data be a little bit higher than expected. Yesterday we saw construction numbers come in higher than expected. We're expecting GDP to be a little bit higher. So we think that in that context, the Fed is going to stay strong and really fight this continuation within the labor market and the tightness that's driving ultimately a lot of the service components of inflation. And so the risk is that the market ends up having to price higher rates, and we are somewhat concerned about how the market's approaching rates, just saying, okay, we're in a disinflationary environment, therefore rates have a place in portfolios, yes, but we do think that there could be a higher level that we're going to ultimately see as some of this plays out over time.
This is fascinating. So the big trade this year thus far, Alexandra, has been that people believe that you want to be getting into the bond market, that the bond market represents the best value right now. You disagree with that?
It's not necessarily that we disagree, and in fact what you're seeing is a lot of asset allocation models are showing, okay, if you're flattening out the path of rates and you're saying vol's going to come down, bonds look like a really great place to be. It's more about the timing. So we've gone to a neutral position in interest rates. We think that they do provide that ballast to portfolio again, but we still think that there could be some room to the upside as this dynamic between growth and inflation plays out, and ultimately we think the Fed is going to be more focused on the labor markets rather than the broader picture of inflation.
What happens to the dollar in this scenario for you guys?
So the dollar has been a really interesting story. Obviously, it traded differently towards the end of the year. And we think that a lot of it's going to be driven by what's happening in Europe, where you have more of a fiscal policy mix and monetary policy mix that's supportive of a currency. So there you're still seeing fiscal support, less monetary support. So we're thinking that that's going to be a driver of demand over in the European currencies.
In terms of US versus Europe, where do you come down when it comes to the equity market? If you're looking at where you think the best opportunity is going to be, is it going to be the US or is it rest of the world? I heard what you say about the emerging markets a little bit earlier on, but what about Europe from an equity point of view?
We think that there's actually a pretty low bar for there to be a strong catalyst in the direction of Europe at this point, especially when you've seen what's happened with broader inflation. You saw some of the prints come down. Now some of them are related to some support from the government, but you are seeing disinflationary environments start to play out there. You've seen, a replacement for gas. You're seeing lower gas prices just due to what's happening with weather. So we do think that there's a lower bar for actually Europe to end up playing out to be a different environment than expected. That being said, we do see and expect to be more issuance on the government side, pushing up bond yields ultimately, and I know they've been rallying. There's been a strong bid for duration there over the last couple of days, but we do expect that to push them up, which will put a little bit of pressure on risk assets, but ultimately we do think that there are more and more opportunities in the rest of the world.
Yeah, I think it's 30 bips on the Bund over the last couple of days. It's amazing, the move that we're seeing. Alexandra, great stuff. Thank you very much indeed for setting us up for the rest of the year. We really appreciate it. Alexandra Wilson Elizondo of Goldman Sachs Asset Management. What are we going to talk about next? We're going to get into the single stock story. Salesforce shares rise as it plans to cut staff by 10%. We're going to have more on that restructuring story next. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ruchika Gupta. FTX founder Sam Bankman-Fried now faces a trial in October on the collapse of his crypto empire. In a court in Manhattan, Bankman-Fried pleaded not guilty to criminal charges. U.S. prosecutors say they expect to produce all the evidence for the case in the next 4 weeks. Shares of Apple are losing their shine after an ugly month. The stock fell some 12% in December, taking the company's market value below $2 trillion. Investors are concerned that matters could get worse because of delays in iPhone production and weakening demand as the economy slows down. And job cuts are on the way at Salesforce. The cloud-based software company says it plans to cut about 10% of its staff in a restructuring and also reduce office space. Salesforce employs about 80,000 people. The company says it's hired too many workers, leading into the economic downturn. And that is your latest business flash. Alex.
All right, thanks so much, Ritika. It is 23 past 7 on the West Coast, so let's get to the startup. We're going to cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Anurag Rana of Bloomberg Intelligence. He joined us on Salesforce and their restructuring plan. Anurag, we're looking at 10% of its workforce. Stock is up over 3%. Is this a they're losing market share thing, or is this a demand thing, or is this that they hired too many things?
I think it's a mix of last two things that you mentioned. They hired a lot of people during the pandemic. And after that, you look at IT spending slowing down. Enterprise IT spending is going to be horrible this year. And I think a lot of this is a reflection of that. We have seen other software companies announce that as well. Shopify did it, in last year. And we expect more companies to come up with similar numbers. They may not be 10%, but we do expect similar trends going forward as well.
Anurag, is this an example of bad management? Is this an example of a company that overhired during a downturn, didn't really kind of get a handle on what really the outlook was really going to be, and is now having to compensate for it? If I'm an investor, I know I'm getting a positive reaction in the stock today, but long term, what does this tell me about the quality of the management team at this firm?
So guys, this is a very common thing in all technology firms. A lot of your sales and marketing and your efforts to, increase your revenue is tied to hiring a lot of salespeople and how soon they get productive. During the pandemic, we saw a massive boost for a lot of the cloud software companies, including Salesforce, and they had to hire blindly at that point. Same thing happened with Shopify. So I don't think it's isolated to Salesforce. I think this is exactly how any business is run, to be very honest.
They have pretty aggressive adjusted operating margin goals of about 175 basis points improvement a year for the next 5 years. How does this go to get them there?
This is one part of it, but I think they can get to it even without any of the big restructurings because they spend a lot more money on sales and marketing than any software company. Salesforce is not a new company right now. They've been, they are the marquee software company out there as it comes to cloud applications. So they really don't need to spend as much on sales and marketing. So we think they can get to this 175 to 200 basis points per year improvement in margins, even without any restructurings over the next 3 to 5 years.
Anurag, is there a macro signal I can take out of this?
Oh, definitely. This is all macro signal. We think all of next year, you could basically pick any software company right now and say how things are going to shape up over the next 12 months. In some cases, the growth rate deceleration is going to be faster. In some cases, it's not going to be that fast. And the question is, what do you really think about it? I mean, deep down, the investors need to think and answer only one question. And the question is, do you think the enterprise tech spending is done forever, or is it going to come back next year or the year after? When I look at stories like Southwest not able to figure out their back-end system or operations, it just tells me there's a long tailwind for a lot of these legacy companies that need to upgrade, which means, next year, I'm going to be happy with what's going to happen to enterprise spending.
That's a fair point.
Okay. Short-term bump in the road, maybe longer-term things certainly look a little bit better. I hear what you're saying about Southwest. The airline industry definitely struggling. Anurag Rana of Bloomberg Intelligence, great stuff as ever. Thank you very much indeed. Up next, more on inflation. The minutes of the Fed's December meeting out later today. Remember, it was quite hawkish. We're going to look at what is driving inflation. Omer Sharif, Inflation Insights founder and president, joining us next.
Markets. Great questions.
All right, we're about an hour into the trading session. We're moving here. Bloomberg's Abigail Doolittle tracking the moves, erasing some of the gains. Now we're flat on that choppy data.
Yeah, this is a wild day for what felt like it was going to be a bullish day, Alex. Right now we have the S&P 500 up just ever so slightly. Earlier it had been up more than 0.5%. It felt like there was some sort of a relief rally after yesterday's wild day to the downside, opening higher and then lower, and then that jobs data, the ISM data, and now net the S&P 500 not doing all that much, up slightly. This as on above average volume. But you can see it's a really interesting day from the standpoint that crude oil is down 4%, closer to $70 a barrel. We also have the Bloomberg Dollar Index down 0.4%, and we have yields down. So you would think that that would give more of a macro tailwind to stocks. Perhaps it will. Relative to whether or not Santa has come to town, if we take a look at what's happened over the last 7 days, and of course this is one of the ways that we try to look at the market and figure out what it will do. But take a look at this volatility, up, down, up, down, up, down. I mean, if you thought that you were seeing these kind of whipsaws, you certainly will. Right now, up ever so slightly. This is basically, if it happens, it suggests that the year will be bullish. But then again, last year, Santa certainly came to town relative to this barometer, and that was not the case. What's pulling on the markets today from an individual stock mover, it has everything to do with these big tech names. So we have a bit of a recovery for both Apple and Tesla, both of those stocks trying to find support. Tesla is back above important support. Apple is not there yet. That's closer to 129. But take a look at Microsoft, down 5.4%, a huge move. Apparently it has to do with UBS's, I don't know if it's a downgrade, but they have commentary out about their cloud unit that growth could be slowing. It seems unlikely to me that a stock like Microsoft, one of the world's biggest companies, could fall so much on one bank's comments, but that could be the case. And then Amazon.com down 2.4%. Maybe Microsoft also has to do with Salesforce.com, some idea that maybe job cuts will be there. Relative to the macro, let's take a look at the S&P 500 relative to the VIX. So here is the S&P 500. Here's last year's bear market. Here is resistance at the 200-day moving average. But you can see, unlike the prior times, the S&P 500 is hanging out here, kind of sideways. It's going to be interesting to see whether this VIX also climbs higher or if it goes back below the range, suggesting that maybe, Guy, you see the S&P 500 do what the DAX has done, what Chinese tech stocks have done, and what the Dow has done, back above that 200-day moving average.
Absolutely. We're going to certainly keep a very careful eye on that line. Abigail, thank you very much indeed. Let's talk more about what is happening with the macro story. Abigail was mentioning some of the single stock stories, but let's focus on macro, because last year was definitely a year for macro managers. You had to get inflation right. If you got inflation right, you made quite a lot of money. And Crispin O'Day, his fund, had his best year ever. These are the best years that Crispin has ever had. 96, 21, 2007, 1993. 2022, though, eclipsing all of them, up 151.5%. There's definitely been some down years in the middle here, but last year absolutely blew all the other years away. As I say, 151% on the upside. A lot of that had to do, Alex, with getting inflation right. It had to do with the idea that he was short, particularly long end gilts. Two particular tenors that he was very short of, the 2050 and the 2061. He got those right and he made huge returns off the back of it. I have to say, though, I think there's probably a little bit of luck as well as quite a lot of judgment here, because clearly the mini budget and the consternation at the long end of the gilt market probably gave Crispin a nice little boost to generate those kinds of numbers.
I know, I was going to say, thank you, Kwasi Kwarteng and Liz Truss. Maybe one of the only people who could probably say that. But to your point, Guy, how you nail inflation, it can really make or break year to year. Last year, no one thought inflation was going to be as high and as sticky as it is. You get that call right, boom, you do really well. This year, we're also expecting inflation to stay high. However, it feels like more conversation is taking place on just how fast inflation can fall, and are we actually positioned for that in the market? And if we're not, where's the risk? Let's get more insight on this with Omer Sharif. He joins us now. He's Inflation Insights founder and president. We'll also take a look ahead to the Fed minutes as well. Omer, what is the risk that inflation falls a lot more sharply than we're expecting?
Yeah, good morning. I think there is a bit of risk to that, but it really is going to be, I think, a function of two main things. One is we all know shelter costs are likely to slow down this year. The question is really when that timing begins. And I think that's a lot of the difference between forecasters, for year-end forecast is, do you see shelter slowing down more towards, let's say, late in the second half of the year? or more beginning in Q1 and Q2. So the timing of that is going to be a pretty big key. As I'm sure you know, the recent Cleveland Fed paper suggests that there's a decent chance we should see shelter start to really moderate around late Q1, early Q2. If we get that, that's going to be a lot sooner than what you've heard the Fed say, which is, consistently their message has been, it'll stay elevated until late in the year. So that's one big factor. And the other, for me, the other really big story is here, medical care. We know hospitals are getting killed on labor costs. They're trying to get more money out of insurers for 2023. We need to see what those numbers look like early in the year, and that's going to happen very soon. January, February CPI, we'll see how much of that pass-through comes into medical care and whether that remains a really big drag on inflation, as is largely expected to be the case.
Omer, Happy New Year. Is the data and the direction of travel that you're talking about going to be enough to force the Fed ultimately to deliver the cuts that the market is anticipating this year?
Happy New Year to you as well. No, I don't think so. I think the Fed's message has been pretty consistent. They want to see inflation get down to 2%. I don't think if we get down to, let's say, 3% on core CPI year-end, and I'm just a little bit below that for year-end core, I don't think that's going to be enough for them. And having sort of been so surprised, as most everybody was in the market as well, on sort of how broad inflation was last year, I think they're going to err on the side of caution here and remain high for quite a while, I think well into 2024. Outright recession, and in a deeper one than the one that the Fed has forecast, is probably what it would take, along with really some sort of financial market turbulence, to really, I think, get the Fed to pivot. But I don't think inflation alone is going to do the trick.
So your call for the end of this year is for core to end up around 2.75% if you deal with the medical costs and the shelter costs. That's not terrible. What number, is it the direction of travel, or is it the absolute number of 2% that the Fed's going to wind up being happy with? And what does an economy look like with 2.75% inflation?
Yeah, so I think the direction of travel obviously is really important, but let's separate those two things out for a moment. The direction of travel is going to be very important, and I think from the market's perspective, really, if you're looking at kind of the tail end of Q1 into Q2, these shorter-term measures we follow to see where inflation is heading. So, for example, the 3-month annualized rate, I think we have a very good chance to have a 2 handle on that number by the February or March CPI reports. The 6-month annualized print will probably have a 2 handle by around April or May. So that's going to be really important from the market's point of view to say, hey, look, the Fed is. The Fed's plan is working. Inflation is moderating. You can see it in the shorter-term trends. And that's great news for the Fed. But I think, we had a lot of head fakes in 2022, right? We had a slowdown in March, followed by a pickup in April. We had a slowdown in July, followed by an acceleration in August. So for them, I think getting down close to 2, somewhere in the 2 to 2.5 range, by year end is really what they're going to want to see before they start to think about rate cuts in 2024. But that direction of travel over the next, I would say, 4 or 5 months is really key, I think, from the market's perspective, to see where inflation will end up by year end.
Omer, the big fear, certainly for the Fed and for many economists, is that inflation comes down but then reaccelerates. As you look further out, what do you see? Does inflation come down and stay down? Or is there a danger, a bit like the 1970s, that things turn around again and we see a reacceleration?
Yeah, I think the risk there would actually be if the Fed pivots too quickly. If they start, cutting rates before they really get inflation under control and expectations under control, I think that's the much bigger risk is the policy error. It's hard to really see inflation, accelerating the way that we saw this spring. And let me just give you a couple of quick examples. One is, think about airfares. We had about a 55% increase in airfares from February to May of this spring as the economy reopened. People switched out from kind of durable goods spending to services spending. The last roughly 4 or 5 months, airfares are down around 16%. We're only about 4 percentage points above where we were in February 2020. So despite this huge move in airfares, we're almost back to where we were, February 2020, back to kind of pre-pandemic type numbers. Very similar for hotel rates. So some of these services that really accelerated a lot this year, I think are going to start to normalize, and some of them have been normalizing as we head through the tail end of the year. So it's hard to see a huge pop coming from that again. And I think on the good side of the story, we've seen the slowdown coming. It's been picking up steam the last few months, and I expect that to continue for much of this year. I think it would have to also be, some sort of huge supply chain disruptions of the type we saw to really get inflation to reaccelerate in the back half of this year.
Feels like another macro year, though, doesn't it? Omer, great stuff, as ever. Thank you very much indeed. We really appreciate you bringing your latest research to us. Omer Sharif of Inflation Insights. Coming up, we're going to talk politics. Republicans beginning their second day in control of the House, in theory. They're doing so, though, without a leader, and there's certainly deadlocks on the way forward. We're going to discuss what happens next and how serious this could become. When does the market start paying attention? Capitol Hill veteran, former Senator Max Baucus is going to be joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. Russia has raised the death toll from a Ukrainian rocket attack on its troops New Year's Day. The Kremlin now says 89 soldiers were killed, the largest such loss it has acknowledged in the war. It blamed the soldiers' mobile phone use for exposing their location. Donald Trump is interjecting himself into the fight over Kevin McCarthy's bid to become Speaker of the House. The former president says it's time for all Republican lawmakers to vote for McCarthy. In 3 rounds of balloting Tuesday, McCarthy couldn't get the GOP votes he needed to become Speaker. He'll try again today. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex?
Hi, Ritika. Thanks very much. Let's stay on that deadlock in House leadership vote. Bloomberg's Anne-Marie Hordern joins us now from Washington. Anne-Marie, any indication that President Trump trying to throw his weight behind Kevin McCarthy is going to make a difference?
At this moment, it just doesn't, right? And you have individuals like Matt Gaetz, who has come out, who's really a staunch no on Kevin McCarthy, saying that it really wasn't at times, the former President Trump's best one of his best ideas in terms of human resources and personnel on who should be leading the party. The issue Kevin McCarthy has is obviously the math. There's 20 individuals that are coalescing yesterday around Jim Jordan, who Jim Jordan is supporting Kevin McCarthy, but he needs to get it if every single member is present to 18, which means he needs to convince all of them but 4 to vote for him. And at this moment, it doesn't look like that's possible.
Anne-Marie, how long does this go on for before the Republicans start thinking about a plan B or moving to a plan B?
We don't know yet. It can go on for days, really, until they start thinking about what the plan B is. And there is no exact plan B just yet, right? They start talking about other individuals that could be the speaker. If it wasn't Kevin McCarthy, names like Steve Scalise, maybe even Patrick McHenry, who runs the House Finance Committee. The issue becomes then those individuals would need to really not back McCarthy now. So it's really difficult. McCarthy would have to back out first before you have anyone coalescing around those individuals. There's also a chance he tries to cut a deal with the Democrats, which really this would be a Hail Mary if the Democrats were willing to do it, in terms of them just voting present on the floor, so lowering that threshold for him to be able to get a majority.
We knew this Congress was going to be difficult. We didn't expect this kind of gridlock. Anne-Marie, thank you very much indeed. Anne-Marie Hordern joining us from Congress. Joining us now for an insider look at what is happening here, Ambassador Max Baucus. He, of course, spent 35 years on Capitol Hill as Montana's senator. He is also a former U.S. ambassador to China. Mr. Ambassador, thank you very much indeed for your time. How do you see this story developing?
There are several obvious points here. Number one, the right wing is more and more emboldened, and that's largely because districts today, congressional districts today, most of them are not competitive. They're either deep blue or deep red, which means that someone from a deep red state needn't try to compromise because he or she has the support of pretty right-wing voters in that district. And that's a phenomenon that's occurred over time that it's more apparent now that McCarthy's having a harder time that there are 20, that number, voting against it. Second, it really shows that this is really a skirmish, maybe the death throes of the future of the Republican Party. Leading up to the 24th presidential election. This old party, I mean, is it going to be a right wing who's going to be nominated for the presidential nomination, or is it going to be somebody who's more mainstream? And this is really an example of that battle playing out.
You served for many years in Congress, Senator. It is nice to talk to you. The markets care about this if it's a proxy for a debt ceiling debate. The holdouts do not want to raise the debt ceiling limit, and in some ways holding that hostage. Is that a correct proxy that the market can be making?